Premiums generated by non-admitted insurers that comprise the U.S. surplus lines market continue to increase, underscoring the potential growth opportunities being generated from market pressures in the property casualty segment. That according to a recent report released by AM Best. The report notes that one key benchmark indicates a 12.1% year-over-year premium increase in 2024 for surplus lines insurers, reporting data to the 15 individual state services and stamping offices nationwide. We're joined today by that report's author, Associate Director David Blades. And David, there's always been an ebb and flow of premium between the admitted and non-admitted markets. What does this latest report indicate in terms of premium shifting between these two areas?
So, historically, as certain lines of coverage or certain risk classes are perceived in the standard market as being more difficult to cover or more difficult to underwrite profitably, that business tends to flow into the surplus lines market, where surplus lines insurers can use their freedom of rate and form to address these higher hazard risks maybe more successfully than they can be in the standard market. I think what we've seen in the post-COVID era, where different macroeconomic pressures such as inflation have hurt or have affected insurers in certain classes like homeowners, or certain lines of business like homeowners, construction classes, et cetera. I think we've seen those classes and those lines of business be, we've seen standard market insurers be a little more risk averse, and counter to that is that surplus lines carriers then have now stepped into the void, whereas the admitted carriers have stepped away from some of that business. Surplus lines carriers have been able to step forward and provide some, bespoke risk solutions for risks in those classes and in those lines of coverage. So I think that's what we've seen specifically over the last few years, and our report shows that over the last 3 years, premium that has flown into the surplus lines market, part of it is for some of those reasons.
How much of an issue have weather-related losses have?
So I think weather patterns have just become more and more volatile in the last several years. And it's not just the last several years. I think if you look over the last couple of decades, we've seen more volatility from a weather perspective. And I think although personal lines coverage isn't typically, homeowners coverage isn't typically one of the ones that surplus lines insurers lead with, we've definitely seen the homeowners line of business be a contributor, and also commercial property be a contributor to the growth that we've seen in terms of surplus lines insurers, in terms of the premiums that they've written in the last several years. So we've seen the volatility, and it's not just in certain states. We've seen actually volatile weather patterns developed in states, a wider expanse of states, and even within certain states, a wider expanse within those certain states, as population has moved to more coastal areas. We've seen more of those coastal risks and more of those high-valued properties end up moving to the surplus lines market because, again, the greater frequency of severe weather-related events has, again, made those particular risks tougher for admitted carriers to write. And so some of those risks, again, the coastal risks and higher value properties have moved into the surplus lines market. So I think weather-related events have definitely impacted the growth that surplus lines insurers have enjoyed.
What are we seeing in the more traditional segments of the non-admitted market, particularly when it comes to liability?
So general liability business, that's overall historically been the greater part of the surplus lines market from a premium standpoint, both general liability occurrence and also general liability claims made, which is really the professional liability lines of coverage. So we've seen we live in a pretty litigious environment in the U.S. And so because of legal and social attitudes towards corporations, we've seen just more and more on average claim costs being higher. And also we've seen claims staying open longer, the impact of either social inflation or sometimes third-party litigation financing, where that has impacted just the attitudes towards pushing for higher claim settlements. And so we've seen claims stay open longer, which increases the claim expenses for the insurance companies the longer that these claims stay open. And we've also seen claim settlements go up higher. So general liability business, as some of those risks and as technology and just the evolution of things just being just more complex, just interconnectedness between just in our society, creating more and more risks. Again, the blur between cyber risk and general liability risk, all those things that have created a greater difficulty for commercial general liability insurers has moved some exposures out of the admitted market and move some of those things that have become a little bit more complex into the surplus lines market. So definitely surplus lines insurers who, again, general liability has been their sort of their lead line of coverage. They've seen more of that business actually over the last several years as well.
So what should we look for in this segment as we move ahead?
So I think we're going to continue to see, some of the things that we've been seeing affecting surplus lines premium levels in recent years. I think from a property standpoint, I think the risks that are facing homeowners and commercial property insurers, as things continue to evolve, as property risks in this country continue to evolve with climatic changes, I think those risks are going to lead to some of the risks that are moving from the standard or admitted markets into the surplus lines market. We're going to actually see those risks, be a little stickier or maybe stay in the surplus lines market a little bit longer. Because again, as these exposures evolve and emerge, I think some of those risks are actually more appropriate for surplus lines insurers. So I think we're going to see that on the property side, and again, on the liability side, because of some of the risks that are involved. Again, there's a greater complexity of risks. Like I said, the risks that are related to just that can be impacted by social inflation, by just the litigious nature and just lawsuits being filed more frequently. And again, the blurring between cyber and general liability related risks, I think we'll continue to see more risks flow into the surplus lines market, or we'll see surplus lines market need to be the market that steps up for more of these insurers, because again, they need creative coverage solutions because of their emerging and evolving risks.
Thanks, David.
You're welcome, John.
That was Associate Director David Blades. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.